Yeah, dude. So I'm just gonna follow your lead.
You got it. Okay, looks like we're live. What's going on, everybody? Welcome back to the channel. Welcome back to another video here. Got a special guest on here, Michael Burns. He's a lender that I work with, really good friend of mine as well. And we're going to be jumping into this, talking a little bit about interest rates, talking about the market, where it's going, what's happening, and just overall what we're expecting to see in 2022. I wanted to jump in here and do this because as we go into spring, I think the market is going to be insane. 2020 was kind of crazy. As soon as COVID hit, things got a little crazy with that. And then surprisingly, 2021 was even worse. I think a lot of people kind of expected it to not die down, but just, kind of flatten out again just because 2020 was so crazy. But it's continued in the same manner that it, was in 2021. And I think 2022 is going to be very much the same thing as well. So with that being said, just want to talk a little bit about where the market's going and share some information here. So as people jump on, if you've got questions, just drop it in the chat box. We're going to chat here for maybe 15, 20 minutes, answer any questions that come through, and then we'll wrap it up from there. So first off, I just want to share some information here with market stats for January. January data just came out, and the number of sales was down pretty drastically from December, which is what we usually expect. Let's see, January of last year, I'm looking at sales of 2,853 homes for the entire Wasatch Front. This January was only 2,500. So sales were down 353 sales from where they were last January. So that's kind of a concern just because we're not seeing as many homes actually out there in the market selling. So Michael, what do you think is going to happen when interest rates go up? They've already started going up over the last little bit. I know that the federal government said, hey, we're going to raise interest rates. Where do you think they're going? Give us like a rundown of like where they've been, where they're going, what you expect to see.
So the Federal Reserve basically, they've indicated that we're looking at 3 to 4 rate hikes this year. So prior to that coming out, inflation is the driving reason for this because we watch that heavily. And for the last year and a half, they've been saying they're not going to touch rates until 2023. But now we're seeing the inflation to the extent that we are. So naturally, raising rates is one of the things you can do to sort of combat that or offset that. So they actually haven't raised rates yet, but mortgage rates are directly impacted, not really actually by the Federal Reserve itself. It's more what the 10-year Treasury is doing, and then also the bond markets. So we've seen rates go up 0.5% in the last month. So I pulled rates today before we got on, but right now, an FHA loan's 3.375 is going to be the par rate with decent credit today. 3 months ago, we would have been at 3. And then 6 months ago, we were probably 2.8 all day long. We had some clients that there was a short window there, probably about almost a year ago, where we were doing 2.25, 2.3. So that's where they're at. A conventional loan right now is going to be 3.875 par rate on decent credit. So 3.8 versus 2 months ago, we would have been a 3.1 to 3.2. So we've seen about a 0.5 point movement across the board. Okay. I think it's going to continue to go up though. But it's really, and this is all of these things they haven't, the Federal Reserve hasn't done anything yet. So there's the markets move with a lot of anticipation, and a lot of news really affects that. So the 10-year Treasury and the bond market will really decide what's going to happen. But I don't know, dude. I think we could see mid 4s pretty reasonably, maybe even 5% towards the end of this year.
Really? You think it'll jump up that high?
I think it's possible.
And when you say that, that's for a conventional loan, right?
Yeah. So FHA, you're going to have a little lower than conventional. But
sorry, go ahead.
I think we had a delay on there. Yeah, I think going into the 4s is probably very realistic, probably by summer.
Okay, for conventional loans. So what can you give us a quick breakdown on why FHA has a lower interest rate? I mean, for anybody who's watching that might be looking at that, just kind of explain the difference between the two and why FHA has a lower rate but may not be the better option.
Yeah, so FHA loans are great. They're designed for first-time buyers, so you're going to have lower interest rates. Underwriting guidelines are a lot looser. It's really a design to get first-time buyers in there. But the reason the rates are a little lower is it's backed by the federal government. So when those mortgages are purchased, they're kind of a safe debt to buy because they're backed by HUD. So if you have an FHA loan and it ends up getting foreclosed on, it basically ends with HUD is who's going to own that home. So because you have that, same thing with a VA loan. VA is guaranteed by the VA, so you're going to have a lower interest rate. And then USDA is another government backed loan. So when you have the government backing these loans in some shape or form, the interest rates are a little bit lower. The downside to FHA is you're going to have mortgage insurance for the life of the loan. So you could be looking at a conventional loan, get on the camera, you could have a conventional loan and an FHA loan, and the FHA rate is going to be a little bit lower if you just look at apples to apples. However, the mortgage insurance on an FHA loan is going to be higher. It's going to be 0.85, where on a conventional loan, we can actually shop that out with different banks we work with, and some of them do it in-house, so we can get mortgage insurance as low as like 0.25 or 0.3. But that's why you're always going to see FHA is going to be lower, and it's just designed to get people into homes. That they're a lot looser on the underwriting guidelines. They'll allow you to have a higher debt to income ratio. If you've had a foreclosure or a bankruptcy, they'll work with that, outside of 2 years, whereas like a conventional loan, it's going to be more like 7 years. But that's why you're going to see that.
Okay. So it sounds like, I mean, for anybody who's looking at this, they may be wondering about their individual situation, thinking maybe FHA is right for me. Maybe it's conventional. Maybe even, something that's not a standard loan product is going to be the right bet for somebody in each situation. So it is kind of one of those things for anybody who might have questions about it, to basically just talk to somebody like Michael and figure out, hey, here's my situation. Here's how much money I make. Here's what my debts are, my credit, here's how I make my money. There's a lot of things that go into this as far as what you can qualify for and, what that's actually going to be, what loan product is going to be the best one for you. So that's what it's most important. So you're thinking the interest rates could potentially go up 0.5% to a full percent, maybe by the end of the year, depending on, where things go. What do you think that'll do to prices in the market? Because typically as interest rates go up, prices should theoretically come down because people have less buying power. But what do you expect to see?
I think it's going to depend on so usually they meet like 4 times a year. So if they can meet anytime they want, the Federal Reserve. But if they do 4 increases like we're talking about, that'll probably be a quarterly thing. I would imagine they probably do 0.25 or 0.25% adjustments would be my guess. That's when they raised rates in 2018. That's what they were doing. They raised rates in 2018 2 or 3 times, and it was 0.25% each time. And in the fall of 2018, rates hit like just about 5% for a minute, and the market stalled out because we were selling our home during that time frame. And then in the beginning of 19, then they lowered the rates back down again. But I think it's going to be, we're talking about Utah. We do loans in multiple states, but Utah is just, and you're on the real estate side, Cody, you see it. There's no inventory. So I just don't think maybe it slows down the entry level, but there's such a demand. I'm not sure it's really going to affect prices. It might slow down the appreciation a little bit. But I don't think we're going to see a dip in prices. I don't even think we're going to see prices leveling out. Like, I don't know if you did the forecast that the Board of Realtors and the economists put together last week, but they're saying like 10 to 12% this year.
Yeah.
I think it's probably realistic.
Yeah. That was the same information I saw, which was interesting. The 10 to 12% I think is realistic. I wouldn't be surprised to see even higher than that, just because of how much demand I see in the market. How many people contact me every day saying, hey, I'm moving in, or I just got a job here, or whatever it may be. There's just so much demand. And the fact that home sales are going down is a little bit concerning. So I just pulled up some information here on my screen. Like you said, in 2018, kind of in the fall, they started raising rates, and the overall the median price along the Wasatch Front for just all housing types was basically flat from June of 2018 through March of 2019, and then once we hit April, then it started climbing again. So it's kind of interesting to look at that and see how prices reacted during that time when rates were going up. I think this is going to be a little bit of a different situation this time. I think that there's a good chance we'll see prices continue to go up, and I think interest rates, in my personal opinion, I think interest rates will slow it down, but it's not going to, instead of going like this, it's going to be more like this. So I don't think it's going to change course or anything. As long as there's no inventory, like you said, it's just going to continue like that.
Yeah, no, I think it'll tap the brakes at best, but I think where interest rates really hurt people is that entry level market the most, because the appreciation has gone up so much. The median price in Salt Lake County is like 500,000 now. So when you're a first time buyer and we've got zero down loans where we're getting in people into a home with zero down payment, or you're an FHA buyer, you got 3.5% down, you're a first time buyer, people, it's hard for them to get, their down payment plus closing costs. And when an interest rate moves 0.5%, that really fluctuates your payment. Like a 0.5% move in rate could be $150 to $250 difference in payment. And if you're already shopping at the top of your debt to income ratio, that 0.5% rate plus an appreciating market, it really just makes the affordability on the entry level a lot harder. So I think we'll continue to see struggles there. But also Salt Lake, this year we're pegged to be the #1 market in the country. Last year it was Boise, Idaho, and then we're actually taking the #1 spot this year, and Boise's the #2 spot. Like you were, so on our purchase loans, I would say 1 out of every 5 buyers is relocating to Utah for the volume we do. And we do a lot of year loans, Cody, and a lot of people you're working with are out of state, but I would say 20% of our loans are people who don't live in Utah currently that are buying here.
Yeah, I get a lot. Oh, sorry. Say that again.
I was going to say, when you have a lot of California migrating this way, even though in Utah, if you're local to here, if you've been around in Utah, our prices are outrageous right now in our perspective. But you have someone that's relocating from California and they see what their money can buy them here, and they're thinking they're getting a deal. And I think that's also a reason why you're seeing, the market continuing to appreciate. We've got all these tech companies that are moving in. All the major banks have offices here, all the MLM stuff. Utah is just a really diverse place. We have the inland port coming. So I just think our economy is so well diverse. And from a business perspective, like, we're good with taxes. It's a great quality of living. You've got all the outdoor stuff. So I don't think Utah's slowing down anytime soon. And if you look at historically Utah, if you look at how we did in recessions, or if you look at how Utah fared in 2008, I mean, we got hit, but we basically did better than pretty much every other state in the country. And I think even if we were to have like some sort of economic situation, Utah is we're pretty well insulated. So that's my opinion on the market.
Yeah, I agree with that. I think that, there could be something that I mean, who knows what's going to happen in the world, but I could see markets that people are leaving from, Detroit or California, these places that like a lot of people are moving out of. I could see a lot of those markets seeing a bigger hit to their real estate prices if, something does happen. But like you said, here in Utah, I think the prices are that the economy is so well insulated that prices are not going to be adjusted, affected all that much. So it's kind of interesting too. I want to see if I can share my screen here, and because I always like looking at stats. Let me see if I can do this. And then go here. All right, give me just 1 sec. Do this. So if I share my screen here, okay, cool. So this is the sales data from our MLS system. So we're here in January of 2022. Like I mentioned earlier, we've had 2,500 sales. We did have 2,500 sales with a median price right here. This is the sales price, so $481,261. This is across all housing types. I didn't put any criteria in here. This is basically everything on the MLS. This is the median here. So 481 homes are still selling, at the asking price or above in many cases. And, days on market was just 12 in January. So it's a little bit higher than where it was, but nothing that's concerning. So, to see this, I think the important thing to note is that sales are down. If you look at all these numbers here, you're in the roughly 4,000 range. If we go back to just this same time last year, we had 4,000 here right as COVID hit, but in 2020, we had a couple of really good 5,000, month, $5,000 sales months. And then it dropped down here in the winter, which we usually expect to see. So that's the thing that I'm really looking at is as long as there's no inventory, I think it's kind of concerning because you're going to see that people are unable to move because they're, housing just doesn't exist. Like if you own a house, right? Like let's say you own a $500,000 house, you want to go out there and upgrade. Well, what do? I mean, because to upgrade at that point, you're spending $800,000-900,000 to make that move up. So unless your income has also gone up, you're kind of stuck, even though you've got a bunch of equity, there's not a whole lot of area, a whole lot of places to go unless you can afford that higher price range. So I think a lot of people are kind of stuck in that situation. What do you think?
Yeah, no, I agree. And I think one big thing that we're going to see just from an affordability standpoint is you're saying like, it's awesome. People who are selling right now, they're selling at the top, but then you're buying at the top as well, or you're selling high, buying high. But when you have an appreciating market, like people who are trying to, we'll use the upsize example. You have the equity that you have, but also if rates go up too, and you have an appreciating market go up, it's like a double whammy because you're getting hit with the market going, say it goes up even 10% this year, which is probably on the conservative side, probably more the 10 to 12 is what's projected. But if you have the market, you sell your home, then you got to go somewhere else, so coordinating that whole thing. But when the market's going up and then you also have rates going up as well, like you're getting tagged twice, right? Like both on the appreciation part. And so I think that, with a lot of people that we talk with and they're looking at, like, hey, we're considering selling, we got all this equity, we want to see what we get pre-approved for to buy a new home. And then they start looking at, they just start looking at it and it's like I think most people are staying put. So that's why you're seeing those numbers. People decide not to list their home because they don't really have a whole lot of options unless they really want to make a move with the financial part of that. But that's why you're seeing those numbers are half of what they were last year or 2 years ago.
Yeah. It's like you said, it's kind of crazy because there's not a lot of inventory. So when something does come up for sale, there's a lot of demand for it. So we're still seeing, multiple offers in a lot of cases. I just had a duplex the other day that we offered on. They had, I think, 14 offers. And it was just a standard duplex in West Valley. It wasn't like anything special. It wasn't, this freshly remodeled property or anything. It was just, there's just nothing out there. So when something comes up, it's a hot commodity.
Well, and so it's just to kind of talk about that too, like for people who are, maybe in the market or thinking about being in the market, it's a lot easier to have that conversation up front before people are buying, of like saying, hey, if you see the home and it's like the one you want, be prepared to have to offer over list price. And like, there's a lot of things you can do up front to be prepared to when you do find the right home, like you're ready to go on it. But also with our clients, we like to have those conversations up front. That way, when you find yourself in that situation, it doesn't seem like we're coming across as salesy as like, hey, this is what it's going to take to get there. You just kind of know that ahead of time. So if you're a buyer that's in the market right now, I think that's one thing to really truly understand is the environment in which it is for buyers right now. It's really tough. So when you have a great agent like Cody that can walk you through that and set a fair expectation, because there's nothing worse than missing out on your dream home over 10 grand or whatever it might be, because now you're going to compare every home in the future to that one. So really just being not only financially prepared and having your pre-approval done, but also being mentally prepared and saying, hey, this is like, it's a tough environment. So we really, got to be aggressive if it's a property, it's our dream home or so one that we want. I think there's the mental piece as well as like getting pre-qualified and all of that stuff. So if you guys are thinking about shopping, I'd really give that some consideration.
Yeah, everybody I've talked to over the last 2 months, I've told them the same exact thing. Like, if you're considering making a move and you've kind of thought, hey, maybe I should do this in February or maybe I should do it in June, I'd say by all means try to move it up, because the market, I think as soon as we hit that spring rush, it's just going to be crazy. Interest rates probably will be higher at that point. Who knows what they'll actually do when it comes to mortgage rates, but everybody's kind of expecting it to continue that direction. So if you're in the market, sooner than later is the best bet in my opinion. And I think that, prices only get worse. And eventually, let's just say worst case prices did crash, right? The median price is at like 500, 550 for a single family home or something. Well, if prices crash, it's pretty unlikely that they're going to go down. They can only drop so much, right? Like at some point, the houses become so valuable that there's going to be buyers for them despite the prices. So if we did go into a recession or something, prices might drop from 550 to 450, but then they're going to continue on. So it's kind of like, the stock market, if people follow that, it goes up and then it drops down, but it doesn't drop all the way back down to where it was when it started. So if you're looking back 5, 6, 7 years, I think you've got a pretty safe investment in the long run.
Another thing to look at that too is, because we have that conversation a lot, people are like, oh, I'm just going to wait. And, in 2020, people were saying, oh, I'm just going to wait, and now, things have not slowed down. But even if, let's say, the market stalls out or it even sees a little bit of a dip, but rates go up, that home at $500,000 today and a 3.8% rate is probably going to be more affordable than the home going, say, 475, $25,000 less, but the interest rate's 4.5. Does that make sense? So even if prices go down, but interest rates go up, your affordability is the same. Like, yeah, you could look at the overall amount that you're purchasing, but the reality is what is the monthly payment? And if you've got a lower interest rate on a higher purchase price versus a lower purchase price and a higher interest rate, it's basically a wash.
Do you think that's a big driver of why we've seen prices go up so much? Is because basically since 2018, rates have been low, and then COVID hit and rates, I believe, dropped again. At least mortgage rates did. Do you think that's kind of been a big driver as to why they've gone up?
Yeah, I mean, we were doing FHA loans at 2.25% on a 30-year fixed loan, 2.35%. It's crazy. Yeah. They're up a point from there, but like the majority of people, when we're looking at people want to get pre-approved. Everything is based on, there's a couple of parts of this. Like, one is the minimum credit score, but really what dictates how much people get approved for is called the monthly debt to income ratio. So each loan type, like for example, FHA, the debt to income ratio maximum is 55%. So what that means is we take your total monthly income and then we pull whatever's on credit. It doesn't matter how much you owe. It's just what the minimum monthly payment is. So we'll take the minimum monthly payment for any debts that are on your credit report, and then we'll throw in the new house payment, and we'll run that all the way up to where we hit the maximum debt to income ratio for that loan. So for a conventional loan, it's 50%. So 50% of your total gross monthly income can go towards debt that's tied to your credit and counting the new house payment. FHA that goes a little higher, 55%. So that's what's going to dictate how much you get approved for. I lost my train of thought there, but so the rates are going to affect what that is with how much your debt to income is. What was your question? I lost my train of thought.
No, that's good information. I was just thinking, about interest rates and kind of how they've affected prices overall, because I think that's been a big driver over the last couple of years. Why rates have, there's been a lot of pent up demand here in Salt Lake and Utah overall. People wanting to get into the market, and then with COVID and interest rates, just a lot of things kind of came together all at the right time, and that's what pushed prices up. I think it was like 38% over the last 2 years. So it's kind of crazy.
Yeah. So with the debt to income ratio, so when you can have that's how you find out what someone's maximum approval amount is going to be. But what I was saying is the majority of our clients are everyone, and you probably noticed this with your buyers too, Cody, is the majority of people aren't qualified for 500,000 and they're saying, okay, I'm going to shop in the 400, 450 range. People are basically going to the top all the time. So any sort of movement in that. So when rates are lower right now and it's anticipated that they're going to go up. So if you're a buyer that's pre-approved right now, for say 450,000. You're kind of in that median price point in Salt Lake, and in the back of your mind, you're hearing the interest rate thing's going to happen. And if interest rates go up 0.5% or 0.25%, well, now my 450 approval, maybe that drops to 425 or 400,000. So right now, I think we're seeing a frenzy of that going on, and that's why people are wanting to jump in the market. But with rates being as low as they have been, people have really been able to stretch their dollar. And I think that's, what's continue to drive the prices up, especially in that entry level price point.
Yeah, absolutely. Absolutely. Hey, Claudette, I got a question for you, or an answer for your question here. So jumping back over here to the stats, I just pulled this up here just a second ago because, again, I think this is important to look at. So you asked what is the average percent over asking that homes sell for? This information here, sorry about that, camera had to reset, is for single family homes only in Salt Lake County, Utah County, and Davis County. So it's kind of the main metro market. I wanted to exclude everything that's out in the rural areas because that's kind of a different market. But here, for these three counties, January of 2022, we saw that it sold for roughly 102% of the ask price. So basically 2% over. Median sales price of $560. The median list price was right here at $550. So 2% over. If we look back, it has been lower. November, December, it was a little bit lower, 100% and 101. But if we go back here and kind of looked at what happened as we came out of winter last year, it's a lot of the same information. January was 102, February 103, and then it jumps drastically going into March, April, May, even June. 107, 105, 106. It jumps up pretty drastically. So if you're looking at housing in the spring or summer, definitely expect to be paying quite a bit over ask price. That's why we're telling everybody, if you're looking, now might be the time to do that. And then it does kind of settle down again as you move into the fall months. You can see here that this is it kind of slowly decreases here. So I expect that same thing to happen. Who knows what will actually happen, but based on all the indicators are kind of pointing to that same kind of market cycle on a 12-month calendar. I think we'll see a lot of the same exact stuff. Jonathan, you got a question here. You're moving in September. When should you really start looking at houses? So I recommend, it's always a good idea to reach out to myself. And sometimes I'll even connect you with somebody like Michael early on, even if it's 6 months out, just to have a conversation, because I think having a conversation at least gets the ball rolling and gives you a better idea of, where you're at in the process and kind of what the next steps are that you need to take. So that's going to be a very quick initial conversation. And then probably about 2 to 3 months before you actually are making the move here, if you want to move directly into your house when you get here, you're going to want to start about 2 to 3 months before you actually make that move, because it might take you a couple days to find a house, or it might take you, 2, 3, 4, 5 weeks, maybe longer. I've had people look for many months on end looking for a house and trying to get an offer accepted. So everybody's situation is a little bit different, but generally about 2 to 3 months is an ideal time frame.
And to add to that, once you find a house and your offer is accepted, we can close stuff as fast as 2 weeks, but your traditional closing timeline is going to be 30 days. So even from the time you secure a house, you're probably looking at another 30 days to go through the closing process, inspections, appraisals, underwriting, all of that stuff. And on the front side, just like Cody was saying, it's really good. You want to get your agent locked in and stuff. And what's cool about Cody and I is we work so closely together with a lot of our clients. The communication is there, but coming up with a game plan. So seeing hey, where am I now? So, a lot of times with our clients, maybe we look at their situation and let's say they're at their credit 660 or 665 and 680 is the next credit tier. So when we look at people's scenario, if they're close on a credit tier, it's hey, if you do this and this, maybe if you pay that card down a few $100, or if you do this, that projected would get your score up to a 685, and that's going to put you in a whole new credit tier, which is going to give you a better interest rate. So now you're going to be able to pre-approve for more, or you're going to have a lower payment on the same one. And that's just a small example, but coming up with a game plan, if you need to rearrange some debt, if we need to work on credit stuff, just different ways structuring the loan, and really having a good idea when you're going shopping, like kind of what down payment expectations are, what closing cost expectations are, different numbers. And then that way, when you're with Cody and you're out there shopping, you kind of know in the back of your mind, like, what the different payments are at different purchase prices. And it really just allows you to be out there shopping in the marketplace with a lot more information instead of doing it the other way around, finding a house, you fall in love with it, and then the financing doesn't line up the way that you want. That's just can be a bad experience.
Yeah. You got to be ready to pull the trigger. Aiden, you've got a question about property managers. I manage all my stuff myself. I believe Michael manages most of his properties. Is that right? You still self-manage all the stuff? So we both self-manage. We've got access to, we obviously know property managers. There's a couple of good ones that I like. I've just talked to employees or the owners of the company and like them as people, which I think is that goes a long way when it comes to property managers. So I would the two places I'd look at would be Key Renter. I've talked to a couple guys over there. I think they've got a pretty solid operation. I've heard of other people working with them and they like it. So Key Renter, and then Pineapple Property Group is another one that I've talked to the owners over there and they seem like solid guys. So I've not worked with them personally because I self-manage all my rental units and Michael does as well. But do you have anything to add to that, Michael?
Rise Property Management is a real big management group here in the Salt Lake area that does a good job. I also like them because the owners own real estate themselves. So it's always nice when you're working with a property management company, whether they're big or small, like, do they have their own assets that they're managing? Because it's just because they understand what it's like, to have a property versus that can't relate to like having an investment property. So I like to work with people who are owners themselves, because I just think there's a different level of understanding. And then also on the property management side too, just my input, I've got a 58 unit portfolio, and people are always asking about like the percentage that, like it's 8% or it's 10%. Like my input on that would be, you get what you pay for. And when it's management, I would not be worried about trying to save 1% difference. A good property management company who's screening your tenants and everything up front, it's just worth the service and the quality that you get. The bad tenant, we've got one right now, and it's a headache and it was costly.
Yeah, I agree. If you're going to pay for property management anyway, you might as well just get the best you can, right? Like I saw a quote today. I've seen it before, but if you think hiring professionals is expensive, wait until you hire an amateur. So yeah, I agree. You get what you pay for, and just something to kind of keep in mind. All right, guys. So if you got questions, let us know. Drop it in the description or the chat box there, and we'll answer it here. We're kind of coming on the tail end. We'll answer any questions you guys have. You want a house hack, a fourplex? Any tips on getting a good deal would be awesome. Yeah, the market is really competitive and prices are high. So, just be expect that. The last fourplex I saw a pretty decent one come up in West Valley, but they still wanted $950 for it, which kind of sounds crazy because I remember 5 years ago, fourplexes in West Valley were selling for like $400,000. So it's kind of crazy asking $950. Rents have gone up a lot. I think I've been telling a lot of my investor clients, I think rents are going to jump up drastically this year. They already started, they already have, because prices have gone up so much that there's a lot of people who are priced out of buying a house and they're forced to rent, or there's just a housing shortage in general. So, anytime something comes up, people are willing to pay a higher rent amount for that place. So I expect rents to be, going up, which will be good if you're buying investment property. You might have to wait a couple years before you start cash flowing a good amount. But Aiden, to get into a fourplex, it's tough. You just have to be ready to pull the trigger. You have to know your numbers. And when a deal comes up, you got to be ready to jump on it and go all in. The cool thing about house hacking is you can a lot of times pay, I'm not saying you would do this, but you could pay 10 to 20% more than the next guy because you're getting a benefit by living there. You're going to be able to live in the property and live for a lot cheaper, and it would be worth it for you to overpay for the property if needed just to get into it. So that's kind of my opinion. What do you think, Michael?
Yeah, no, 100%, because investors can't compete with someone who's going to live there. And Aiden, that's really cool that you're looking at that. Buying and if you have any questions on the financing, we can talk to you about that. But when you utilize your first like FHA loan, or you can go conventional too, but when you can grab a 4-unit property that you're going to live in, and then obviously you won't live there forever, and then you convert that into a rental property, because you're buying it owner occupied, the down payment requirement is a lot lower. It's a lot easier to qualify and get into that as well. And then that's also why you're just going to be in a position to where you don't have to have the same property performance that say someone who's buying it as an investment property, and they have to have certain debt coverage ratios and things like that. So it's a great advantage that you have in the market, even though it's an extremely competitive market. When you're looking at a multifamily situation, you're going to live there yourself. You actually have the advantage, I think, in a hot market.
Absolutely.
And rates are better too on an owner, like primary residence or owner occupied, where you're going to live there. The interest rates are a lot better, and down payment requirements are also lower when you're going to live there versus if you're buying it as an investment property. The interest rates are going to be higher, and down payment requirements as well.
Yeah. Aiden, real quick, I was just looking at the question. If this is like your first property, I would even recommend self-managing. You asked about property managers. I'd recommend self-managing while you're living there, at least for the first year or two, just to kind of get familiar with what that entails. I think it's a really good learning experience, and it's extra work, but you're going to save the money on a property manager, and you're going to learn a lot. So I think it's a good thing if that's kind of what you're looking at. But yeah, reach out to us if that's what you want to do. I've house hacked, I think, 4 houses.
Yeah.
And just moved on, bought one, lived there for a year, moved on to the next one, did the same thing, and then finally built up to where I don't have to do that anymore. So it's kind of nice to get to that point. Patricia, thank you for watching all the way from Chile. That's pretty cool to see. I love seeing people international. I've had people reach out literally from Japan, South Africa, Dubai, a couple places in the Middle East, actually. I've had people from all over Europe, and of course all over the United States. California is a big part, but also the Northeast. A lot of people watching from New York, Boston, Philadelphia, etc. So any last questions, guys? We're going to wrap up here. So if you got a question, hurry, drop it in the chat box. You lived here 40 years ago. That's a long time, but that's awesome.
You wouldn't even recognize this place anymore. Your eyes would pop out of your head.
Yeah, I was going to say 40 years ago, man, Utah was just a blip on the map at that point.
Yeah.
Wasn't much here.
Little Utah, #1 market in the country.
Yeah, exactly. K-Jax, how bad has the inversion been in the last 2 weeks? That's a good question. Go for it, Michael.
It cleared up. It cleared up yesterday. I see it all the time because I kind of live on the East Bench and I have a view of everything. But and those of you who aren't familiar with inversion or Utah, Salt Lake's like a big bowl because we got mountains on the east side and mountains on the west side. So what happens is some of the air will kind of come in and settle down, and then we need a storm or something to come blow it out. So we just get like pollution or smog. Essentially, you just get this film. But it can get pretty bad in the winters. And that's the downside to Utah growing as much as it is, and the amount of just pollution and stuff that naturally comes with that. I think that's definitely probably a concern for the state moving forward. But it comes and goes, but usually doesn't last longer than a week or so. We get some wind in here and blows it out.
Yeah, absolutely. I was just looking on my phone. Air quality says it's 35. I don't know what that means, but it says it's good. So, it was pretty bad like a week ago. Those are the days where I always say, get a couple good air filters in your house, try to stay inside, or if you can, get out of town. That's when you go to Park City if you just want something close, or you, go on vacation if you can kind of plan around that. I mean, we did that a couple weeks ago, my wife and I and family. We went down to St. George and got out of the inversion and whatnot for a couple of days. So You're here next weekends with the wife scouting out areas. That's awesome, man. Let me know if you need any advice or have any questions when you get here. So, all right, guys. Well, we're going to wrap it up there. If you're thinking about making a move here to Utah, make sure to reach out, call, text, or email anytime. I'd love to chat with you about the type of home and lifestyle that you're looking for. As always, you can find my information on any of my videos. Once you get to the financing side of things, there's a really, really good chance you're going to be talking to Michael as well, unless you have another, your own lender that you're already working with. So you'll be talking with both of us throughout the process, and we'd love to help you. We've helped people from all over make that move here, even locals. I know there's a fair, 10 to 20% of people who watch the channel that already live here. So if you're already living here and you want to buy, sell, or invest in real estate, reach out to me. I love working all three aspects of it and would love to help you as well. So thank you guys so much for watching. We'll catch you in the next one.